Yes, once again, good morning all. Yeah, one second. Okay. Yeah, so first of all, welcome everyone. So, welcome you all, everyone gathered here on a weekend. So, today we gathered here for a Q&A with OmniScience Capital, which is a small case fund management team, right? So, so already Vikas Gupta and Ashwini has joined from OmniScience. Hope everyone will be joining soon. All community members will be joining soon. So we'll start anyway, right? So so as everyone know, many of you guys already aware of small case investment, and many are new to small case investment. To give a brief about small case is a platform where the high-end research team and the fund management team and PMS company fund managers all are coming across, and they are giving their best research portfolio to all the retail customers. So as an investor, we can go to the small case platform and we can subscribe their small case basket. So they are creating small case basket, right? So they will be creating a basket which includes all the stocks portfolio. So we can subscribe the portfolio and we can invest on the fund manager code, right? So what are the changes they making, say quarterly basis or yearly basis? What are the changes the fund managers do? That we do get the notification and we can just update on our portfolio as well. So small case is a wonderful product. So someone looking for a long-term wealth creation tool with an aggressive return, I would definitely recommend small case to be one of their best way to invest. So someone investing on mutual funds, I can say that say it is a kind of bit aggressive for them. Say it's an aggressive investment as you are getting more return as well, or when you coming to a small case platform, right? So anyway, we will start the session for today. So anyone, if you having any doubt, please write on the chat. So we will be taking all the questions in the end of the session. So yeah. So anyway, we need to welcome our present, I mean, guest today, right? So we will be starting with Vikas Gupta. So many of you guys may not be knowing Vikas for the time, right? So I'll just give an introduction to Dr. Vikas Gupta. So he's a CEO and Chief Investment Strategist of OmniScience. Vikas Gupta founded OmniScience Capital to provide a scientific approach to equity investment in global and Indian stock market. So talking about his an earlier multi-asset class firm, he incubated the global listed company vertical, which won international awards and rankings, includes the top one long bias equity manager for 2014 across 11,000 plus hedge funds by Brickell. And he also holds a BTech from IIT Bombay and MS and doctorate from Columbia University, New York. He also also served as a scientist and professor at University of California and IIT Kharagpur, respectively, right? So, welcome, Vikas, to the session.
Hello, everyone, and thanks, Vivin, for the excellent and kind introduction.
Yes.
Unfortunately, my video is not starting.
Okay.
For some reason. I've tested separately on Zoom, but all the time it starts. Today it's not happening. So you'll have to bear with me without the video.
Okay. I mean, please try again if possible. So meanwhile, I'll introduce Ashwini as well here. So yes. We also got Ashwini here, who's an executive vice president and portfolio manager in OmniScience Capital, right? So Ashwini is a co-founder of OmniScience Capital, bringing scientific investment to global markets. Ashwini leads advisory and investment management activities at OmniScience Capital. He brings in 15 years of experience in the financial market industry. Earlier, he was worked with Goldman Sachs as an equity research analyst. He has a BTech and MTech from IIT Bombay and earned his MBA from IIM Lucknow and Toulouse Business School, France. Right. So welcome, Ashwini, to the session. Yeah. Ashwini, you there? Hello. I think Ashwini, you are not able to mute, I think.
able to connect?
Yeah, I think he's facing some difficulties over there. Anyway, so Ashwini will be hopefully he'll be on the chat. So anyone having doubts or something, he'll be texting you guys. So definitely ask your questions on the chat. Okay. So as a session, what we are planning here is that first 10 to 20 minutes, Vikas will be presenting about OmniScience Capital, about their basic strategies and about their products. So after that, yeah, I think because we can see you now.
Okay.
Yeah, I mean, now again it's gone. Hopefully it'll be fixing up, right? So once the presentation is done, we will be open for the Q&A. You can ask about the products which they're already having. And I hope you guys already visited fundfolio.smallcase.com, where we as a market feed, we recommended few of the small case, which is a preference for us as a community member. We are kind of traders, right? So as an aggressive investors, you can get many of the products which is suitable for small case. So few of them we already like that we listed on our website, which is on the fundfolio.smallcase.com. You can get all the recommended small case there. Okay, so anyway, we are not making much news here. We already late for the show, right? So moving on to Vikas. So Vikas, over to you.
Thank you. Fortunately, I think still we have some trouble with the camera, but on its
okay.
own, it's switching off for some reason every time I put it on. So, Ashwini, are you going to share the presentation or?
Yes, I'll put it up.
Okay, perfect. Super. So let's just begin with this. And so as you can see, it's a joint effort with Fundfolio, Smallcase, and OmniScience Capital. The main point I want to highlight here is enhanced safety, enhanced growth, enhanced returns. Okay, so keep this in mind as far as OmniScience Capital is concerned, is that our first focus is see, I know you are all high risk investors with experience in the markets and doing, trading, etc. for a long time. But still, when you are in the equity markets, and we are talking of investments here, so for the long term, so the focus has to be safety first. That is at least our approach. Then focus on growth, because that is what will add returns over the long term, and then enhance returns. So this enhanced returns is something which is our specialty in how we do the stock selection, right? So there is some little bit of magic there. We'll talk about that as well. And the idea today is also to focus on SIPs. Okay, so we were having some discussion with Vibin earlier, and the focus is that whatever you are doing through trading, etc., and you're making some surplus capital, you can deploy in a systematic manner on a monthly basis. You can keep adding, and you will see the magic of compounding. That small amount which you transfer and build over long term, that ends up creating significant wealth. Let's go ahead. Ashwini, next slide, please. Thank you. So that's okay. Move on. That's our contact information, etc. You can follow us on Twitter and LinkedIn, Facebook, etc. We are there, even on Instagram. So you'll keep getting some updates about what we are doing and things like that. Okay, so this, I kind of highlighted that in the enhanced safety and enhanced returns part. But again, I'll re-emphasize, this is the core Omni insight, that people chase alpha. And when you chase alpha, you have to do high risk things. So what ends up with most people in their portfolios is they end up getting risks. While this is our insight from an investment point of view, long-term investment point of view, that if you chase safety, you actually end up with alpha. Okay, you will realize that you actually end up being ahead of the market in most cases, and probably beating most of the competitors. So these are our 3 focus areas as a company. Today, of course, the focus is on India with Smallcase and Fundfolio. But just to give you an awareness of what OmniScience is, we focus on US markets, we focus on India markets. Both are very promising markets. And the third thing, which is at the center, is you have to realize that there is an AI revolution, artificial intelligence revolution. Okay, so the focus on technology investments, because that is disrupting and transforming the global economy and Indian economy. Okay, so and you have already experienced that. Like 10 years back, you would be taking taxis and things like that. Today, Uber and Ola is how you do. 10 years back, you would be focusing and going to movie theaters. Today, you are using OTT platforms like Netflix or Amazon Prime or Hotstar and things like that, right? So this is just some small sample. Payments. You used to go to the bank, withdraw cash. Today, you're just doing UPI transactions or other payment methods. So not even going to the ATM. So things are very, very different now. And you can imagine 5 or 10 years from now, how different things are going to be. So having emphasized that, and we have created a way, even from Indian rupee investments, get exposure to the global economy. We'll talk about that as well. Let's move on. So I'll not spend time on this. This is the evolution of OmniScience over 2 to 3 decades. How all this scientific investing framework has come up. So it's highly entrenched in the scientific thinking foundation, which I have, during my undergraduate and graduate days, and the PhD and being professor, etc. So it gives you a very different way of thinking, and that's what we have brought to investment management. And naturally, it will give you a different style of investing, which I think we have already proven that it works. Of course, nothing is, we've not invented anything out of thin air. This is based on more than 100 years of investment research. And as Newton said, if I have seen further, it is standing on the shoulder of giants, right? So who are those giants? You can see, Benjamin Graham, who's guru of Warren Buffett, then partner of Warren Buffett, Charlie Munger, guru of Warren Buffett, Phil Fisher, John Burr Williams, and so on. So there are tons and tons of these very well experienced investors, and we have built upon that. So of course, you can do more things beyond that, and that's what we have built up into scientific investing. Let's move on. So this is the part where we enhance safety. So we eliminate from the full market, we eliminate companies which are capital destroyers. These are companies which are destroying shareholder capital by taking too much debt or things like that, or loss making. Capital eroders, this is a little bit more difficult concept, but simple words, it is earning less than the cost of capital. And capital imploders, these are companies, you keep hearing about on TV and newspapers, and everyone says invest in this. All research guys, all fund managers, they are saying, oh, I love this company. So it's a great company, but to us, it is not a great investment, because many times these great companies, when everyone is talking about it, means that it is overvalued, probably significantly overvalued. So it is ripe for an implosion. Okay, so anything goes wrong, even if there is a little bit of slowdown. So for example, last 2-3 days, you are hearing about Netflix, right? It's down by 40%. Why? Because it lost it has got more than 200 million subscribers, and it lost 2 lakh subscribers. Okay, and it actually did not lose 2 lakh subscribers, it actually gained 5 lakh subscribers. But because they have shut down Russia, and they had 7 lakh subscribers in Russia, that they have shut down because of the Russia-Ukraine war, and you are now at -2 lakhs. Okay, and market is reacting so badly because market expected 25 lakh subscribers to be added. Okay, so this is what capital implosion does. Is when a company, and same thing is happening in India with, let's say Jubilant Foodworks or companies like that, or so capital imploders is the most subtle part. What is left is capital multipliers, and this way we have now enhanced safety and the expected returns have been enhanced. But even more important is the next slide, which is the next step is to enhance growth. So this is where you will see the way we think. This is about thinking about growth vectors. Okay, so growth vectors, and some people call it themes, but this is a more well-defined concept. Growth vectors is not it's a growth opportunity which is well defined, which is going to last for probably at least 5 years, possibly a decade or two. Okay, and the demand side is so strong that, and second part is the number of companies. A growth vector is not exposed only to one company. You will usually find a cluster of companies which can benefit from this growth vector. So that's how we think and try to find in the market, and we are able to find most of the time. Second part of this is that it should not be recognized by Mr. Market. So it should not be known, well known. If it is well known and everyone has already invested in that growth vector, then it goes into a bubble. Okay, so for example, consumption or FMCG is like that, or was like that 2-3 years back, right? So when it is in a bubble, you are not going to make any returns. You're just going to make at best the discount rate, and you have a risk of what we mentioned earlier, capital implosion. As opposed to that, when you go for, at the top of the screen, you will see Mr. Market's blind spot, below the radar growth vectors. That is where you want to be. So you want to buy things which are at a blind spot, and when Mr. Market realizes them, when they go into a bubble, that's when you sell. So you buy Mr. Market's blind spot, you sell Mr. Market's mirage. So this is what scientific investing is, and you compose a portfolio of multiple growth vectors. So you have diversification across growth vectors. Okay. So this is the second way you enhance returns. And the third way is valuations. Okay. When you buy significantly below its intrinsic value and sell at intrinsic value or higher, then you are going to make the extraordinary returns. Let's move on. So how to build wealth with OmniScience small cases. Okay, so these are supernormal companies at supernormal prices, and you can build wealth with our core investment and SIPs. So if you remember just one thing from this presentation, just one thing, what would that be? This is the slide you keep in mind. The rule of 15, 15, 15. 15,000 rupees per month SIP at 15% return for 15 years gives you 1 crore. Okay, we think 15,000 is such a small amount. Even if I save it, even if I invest it, what will happen? Okay, and yes, so even if you do it for 1 year, nothing happens. It's around 1.8 lakhs. So nothing happens. Okay, it looks like very small sum and so on. But long-term market returns is around 15%. And if you just had compounded it for 15 years, it's a very large number. I'm not saying, many of you have multiple crores, I'm sure, but it's still a significant sum of money. And you have more money, by all means, put 1.5 lakhs per month. If you can do a SIP, and you will see, 10 crores, right? Instead of 1 crore. So just keep this 15, 15, 15 SIP rule. So power of SIP, power of time, power of Mr. Market, and power of the investor. Keep putting 15,000 every month for a long period of time. So this is the slide I want you to remember. Let's go on. So this is our first product, Omni Royals. It's a large cap investment. So when we say large cap, what we are doing is we're taking the AMFI defined top 100 stocks by market cap, and from within that we choose somewhere around 10 to 12 or 15 stocks. Okay, the current basket and the ticket size is 16,000 rupees currently. Of course, it keeps fluctuating with Mr. Market going up and down, right? Because the stocks we have and the weightage we have given, if some stocks appreciate, then the ticket size becomes slightly larger till the next rebalance. And then we will bring it back to approximately 15, 16,000. We'll try to keep it below 20,000. Okay. So right now there are at least 4 growth vectors I would like to highlight, which this basket provides you exposure to. One is digital transformation, which is $100 trillion kind of a global impact over the global economy in 10 years, according to World Economic Forum and Accenture research. That's 32% of the exposure, portfolio exposure. Second is digital banking and housing finance. So this is also a multi-trillion dollar opportunity. So digital banking, I just gave a hint earlier, right? Like payments we are doing through UPI and things like that. And nobody is, most people do not need to visit the bank anymore. They do not need to visit the ATM anymore. And most of the time you hardly even need to go to online banking. From the mobile itself, you are able to do so many things. And so that is just the beginning of digital banking. Digital lending is already happening. And housing finance, of course, in India, we know that's a great opportunity. And the next one with immediate, next 3 to 5 year kind of a thing is the infrastructure opportunity. Huge government spending is happening through the national infrastructure pipeline on infrastructure. And that's an exposure we are getting through this portfolio partly. And then power. So power is a special focus of the government. So there is huge capex happening. As GDP grows, naturally the demand for power grows. And that is another exposure growth vector we are providing here. Okay, so over next decade, by 2030, there is an expectation of India transforming significantly, probably getting closer to $5 to $8 trillion kind of an economy. And that naturally, Omni Royals is providing you, of course, the other products as well provide you exposure to that. But Omni Royals having the larger companies is absolutely suited for that. Yeah, let's move on. So this is the fundfolio.smallcase.com. We're just giving a screenshot from that. You can go there and you will be able to subscribe onto Omni Royals. So it shows you the volatility, that it's a medium volatility, right? So moderate investors can also go for it, moderate risk profile investors. It gives you the 1 year CAGR. It says 1 year, but it's the annual CAGR from since inception. Okay, minimum ticket size, so around 16,000. Our fees, and then you click on subscribe now, and you will be able to subscribe. So this is our mid cap Omni Nights, supernormal mid cap SIP. It's designed for SIPs. So 20,000 is the current ticket size. And you get, many of the same growth vectors, plus additional, you are able to get defense growth vector here, mobility. And so mobility is, electric vehicles and things like that. Defense, of course, you are aware. So defense is aerospace and electronics for various military and forces. Power we already discussed, infrastructure, DX, digital transformation, which is technology transformation, that we already discussed, right? So digital transformation, since I didn't spend too much time, just to explain to you, it's based on, first of all, all the 5G, 4G, 5G, and the Internet of Things, and that we are doing all our things online now. So all the data, all kinds of information is online. It's being moved to the cloud. Okay, so IoT data is collected, moved to the cloud, and then on the cloud you start doing analytics on it. So these are big data, analytics, artificial intelligence, once the data is in correct format, and then that artificial intelligence is brought back to the business by the companies to do better marketing, better product creation, better customer service. Okay, so we are seeing all of that happening, and that is digital transformation. The whole business of transportation, for example, has gone from the way it was being done, where the taxi guys could refuse to take you from point A to point B. Today you have Uber and Ola, where you have a little bit of more uh, 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 reliability. Of course, they also cancel, so I understand that. And on TV, like you would use TV and you would have to watch what they are showing today. But with OTT platforms, streaming platforms like Prime and Hotstar and Netflix, you're able to choose what you want to watch today, right? So that is part of digital transformation. Yeah. So again, you can see that this is classified as high volatility, which means it's suitable for higher risk investors. The returns since inception, the minimum ticket size, and subscription, now. Go on. So this is the most aggressive investment strategy, which is the small cap, right? Omni Super Trans. The ticket size is also smaller. And here you're getting exposure to defense, again, railway infrastructure, okay, which is huge. Railway has a very, very mega plan over next 5 years, National Rail Vision, and next 10 years to gain huge, significant percentage, nearly 45-50% of freight, railway freight they are trying to target. Okay. Not only that, you would be seeing all over India things happening, things like metros. There are more than 30-35 cities. Metro projects are going on at a very fast pace. Many of them are already operational, and many new lines are on the verge in the pipeline, right? So there is huge amount of railway trains are getting transformed. The electrification is going on. Double lining or triple lining or quadrupling of lines is going on, building capacity, and new kinds of railway coaches, new kinds of stations are coming up. So there is huge change happening, and this is giving you exposure to that. So again, it's high risk product, but the ticket size is just 10,000. And this is our flexi cap, which means this product gives you exposure to the best stocks. We call it the best of India, whatever is available, whether it's large cap, mid cap, small cap. And you can see the number of growth vectors you're getting exposure to here, nearly 9 growth vectors. So digital transformation, rail infra, defense, power, capital enablers. So capital enablers are things like rating agencies or stock exchanges, so which enable companies to raise capital. Okay, and they bring about the efficiency in how capital is created. So all of us put in small sums of money we have invested. These enablers are allowing you to put together all of that capital and deploy where capital is needed, right? And then generate those returns and bring it back to us. So that's the kind of infrastructure, right? Rating agencies, stock exchanges, other fintech, etc. Digital banking we already talked about. Mobility we partly talked about, and then housing finance, infrastructure. So these are the 9 growth vectors you're getting exposure to. The good thing about having multiple growth vectors in a portfolio is that every quarter you can expect, every quarter to 6 months, at least 1 or 2 of them will unlock, which means Mr. Market they will move from Mr. Market's blind spot into Mr. Market's mirage. Okay, so go from undervaluation to fair or overvaluation. So for example, I'll give you, we had digital transformation started as early as 2016-17, but we special focus we gave in 2018. And by 2021, it was unlocked. Okay. Now you take defense, we started adding defense somewhere in Jan 21. And you can see, or even slightly before that, but then, in November, Nifty launched a Nifty Defense Index. And now recently, HDFC has launched a HDFC Defense Fund. And last 1 month, you will see 1 to 2 months, defense stocks are in demand in the market. The prices are increasing. And when the fund gets raised, you will naturally see that there will be more unlocking happening. Then power. Again, power is our power growth vector is unlocking recently because Mr. Market is realizing what is happening there. So this way, one by one, things will be expected to unlock. Medium risk, ticket size is around 75,000 rupees. Of course, when you go to fundfolio.smallcase.com, you will get a fund fact sheet, you will get a chart over the long run, etc. And you can look at that and make your decisions. Now, there are people who have their own belief systems where sometimes, you don't want financials, you don't want alcohol, etc. So for those kind of investors, we have designed a belief compliant strategy. Okay, certain kind of food items are not allowed to be invested in. So all of that is taken care of here. We have given the criteria. So for people who find this suitable, you will be able to invest in that. So this is also flexi cap, but it's just that from that whatever is not suitable based on the beliefs, we have taken out. So you can again learn more on fundfolio.smallcase.com about this strategy. This is also medium risk, around 90,000 is the ticket size. So digital transformation I did speak about. This is a larger ticket investment because we are giving exposure to multiple stocks. And many stocks, the ticket size itself of us, even a single stock is higher. So this is a very comprehensive kind of exposure. And that's why the ticket size is in this range of 2.3 lakhs. Some of the important growth vectors within digital transformation we have highlighted, which is artificial intelligence, cloud, 5G, Internet of Things, and blockchain. Okay, there are many more like, augmented reality, virtual reality, metaverse, cyber security, and so on. But we've just highlighted some of the main ones. And you can see each is a multi-trillion-dollar kind of a impact. So this is a very important exposure you need to take. We have given it partly in the SIPs and super stocks and things like that. But if you have a large corpus of 25, 50 lakhs, etc., then definitely you should put in at least around 10% into this for the long term. Of course, given that, it suits your risk profile and investment horizon and investment objectives. So this is a high risk, high volatility. You can see that. Returns it has generated over the last few years is extraordinary. But I'm not saying that you should expect the same numbers going forward. But we think it's a very, very promising exposure. Be the disruptor, I say, rather than the disruptee. Technology is disrupting the world economy. You be the disruptor by investing in digital transformation, rather than be in non-tech investments, and those companies will get disrupted. Okay. Yeah, so this is for people who are putting money into the bank fixed deposits. Fine. I mean, if you have absolutely zero risk profile, then definitely put that amount of money in bank fixed deposits. But today, this portfolio is giving you more returns, higher dividend yield, about 6% plus, while the bank FDs are giving you 5%. Okay, and the second problem is if you are in bonds, long-term bonds, they're still giving you 5-6%, but as RBI starts increasing interest rates, you will, face a possible potential loss. Those bonds could fall in price as RBI long-term bonds. Even Government of India AAA bonds, even they could fall as interest rates are increased by RBI. So this is an alternative to that. This is higher risk because it's all equities, so it will fluctuate. But then there is also not only you're getting that 6% yield today, plus yield. On top of it, there is a chance, significantly good chance of capital gains, because these are companies which are very good businesses and they are also growth businesses. Many of them are growth businesses. Okay. It is low volatility. So even for lower risk profile investors, it is suitable. But of course, you have zero risk. Some capital you need 6 months later or 1 year later, 2 years later, I wouldn't recommend. But FD you are doing for 3+ years, 5+ years, I mean, this is better to do. Okay. Ticket size very, very small. It's just 10,000. So we have shown this because it was selected by Fundfolio, but right now Smallcase has blocked this. So I will talk about this, but right now you won't find it available because here we are providing global exposure through the ETFs, global ETFs listed on Indian exchanges. The problem is right now there is the limits of mutual funds to invest globally. The limit put in by RBI and SEBI have kind of reached. So until they increase those limits, more net inflow into global ETFs is not possible. And that's why Smallcase has blocked this portfolio. But this portfolio is giving you exposure to global companies. So in that digital transformation, which we talked about earlier, all of that exposure is there, but you have nearly 50% exposure, 30 to 50% exposure to global companies here, like Google, Apple, Facebook, Microsoft, Amazon. Okay, these are companies which are transforming the global economy. And Intel, Qualcomm. Okay, Qualcomm makes the chips on your mobile phones. Intel makes the chips for your laptops or PCs, right? So those kind of companies, you are able to get exposure through this product. Let's move on. So this is not available right now temporarily. Yeah. So this is the team. Okay. You couldn't see me on video, so you can see my picture there. Go on.
Yeah, it's
next
actually
slide.
visible because now your video is quite clear. Yeah.
Okay, great. So this is the investment team. Ashwini Shami, you are already interacting with, and Varun Sood, he's not there, but he's the engine generating all of the picks. Okay, go on. So we have like 2,000 companies listed. From that, how do we reach those 20-25 companies which we want to invest in? And then in US markets, we have 1,500 companies, 3,500 total companies, out of which 1,500 is the universe. And then we pick 20-25 stocks. So all of that is done with scientific investing. So this is our board of advisors, Asit Mehta Group. Go on. Next slide, please. Yeah. Yes. Okay. We'll stop here. Yeah. Disclaimers, disclosures. This is very critical. So there is no recommendation. You have to go to your financial advisor to plan your finances. And just because I say that, okay, this is great, we are not trying to say that you go and invest. You have to do your own analysis, take the advice of your financial advisor, and invest accordingly. Okay.
So yeah, thank you so much, Vikas. I mean, it was a say clear picture we got about the products OmniScience is offering. So yeah, so now we are opening for the Q&A. So whoever having a question about the products, say about OmniScience products, please do ask on the chat. Okay. So meanwhile, say I just want to ask few questions which I already seen on your presentation. So most of the products which is discussing about the rail infrastructure or say infrastructure kind of where the government spending needed. Okay. So many of us as a retail investors do have a doubt that when after the by the hit of corona, government is also is not in a well position to spend more on the infrastructure side. That's what retail people think, right? So so when we can expect a good spending is happening on the infrastructure side, and say what is your thought on that side?
So what we are seeing, I understand the doubt which people have, but the fact is that on the ground, actually, there is huge amount of investments happening. Okay, and the projects are proceeding as per timelines. Okay, there could be a little bit of delay. I'm not denying that, but still things are moving despite COVID. During 2020 and 2021, lot of projects have been going on, and you would be in each of your own cities, you would be seeing, for example, in Mumbai, we are seeing the metro projects going on daily, experiencing the traffic jams, but also seeing the progress on the metros,
Okay.
so so things are happening. You can see railway stations across India or new kinds of trains being introduced. So all of that is happening at a significant pace, and power projects are going on. Reforms in power projects are going on. Okay, defense spending. We are exporting. Last 5 years, the CAGR for exports, defense exports, which we would think that India can't even export. Okay, who will buy from India? We ourselves import, but actually, huge amount of defense export is going on, and government expects to increase it significantly in next 5 years. But already 28% kind of a CAGR is there, CAGR growth rate over last 5 years, and we have seen orders coming from Philippines for the BrahMos missile, orders coming from or RFPs coming from Malaysia, etc., for the Tejas aircraft. Okay, so there's a lot of interest globally in Indian technologies and defense. This is just an example. So the capex is happening, and not only government companies, private companies, all are benefiting from that. But we have to look for those companies, okay, and invest in those companies where the order books are there for last, next 6-7 years.
Yeah.
So high visibility.
So say there are many stock pickers here. I mean, it's not your part, but I would like to add your personal comment on that, because say many of us see that Adani, say as a person, he is a what I can say is the richest person in India, right? So when you're saying about the infrastructure, are you expecting Adani companies will be getting more added advantages as they might get more business, as you said?
Maybe we don't have Adani companies in our portfolio. Okay. So because as I showed you, our scientific investing process goes by the facts. Okay. What is in the balance sheets, what is priced in the market, and we analyze all of that, and what is not priced in the market, but it's on the balance sheet, right? Okay. But market has not realized that, is what we have in the portfolio. We don't chase what I clearly told you, that capital imploders, companies which are on the TV, on TV screen, on CNBC, ET Now, Z Business, CNBC, Awaz, etc. Those or in the newspapers, those companies are most likely being chased by Mr. Market. Most likely they are overvalued. They might be great companies. I'm not saying they're not, but there is no point in us investing in those. What you want to invest in is what is unrecognized by Mr. Market. Okay. And so that's why, while Adani might have advantages, and it's not just, when someone is doing business, they are able to deliver. There is some capability in the company also. Okay. But we don't care. That's not the way we invest. That is more speculative in our opinion.
Yeah.
What is clear is where we invest.
Yeah. Very clear. Yeah. So, say there is a very common doubt in the market, say, when coming to the small case, say platform, whether need to do SIP or by lump sum investment. So, what you do suggest? I mean, say, looking into the current market, it is a better time to start an SIP or a lump sum investment. What is your preference over
The absolutely great question. Right now, you'll realize that we are still below the previous market peak, right? For some stocks, it was around October, some stocks, it was November, and for some part of the market, it was January, right? That was the peak. And we are below, we are around, let's say, 10% down compared to that. And so you're getting a sweet deal, you're getting a good deal. And so it is ripe for long-term investments. Okay, even in those peaks, I don't, we were very clear that it's still a good, very good opportunity from long term. Okay, so you're getting an even better situation today. Having said that, we know the uncertainties facing us, which is the war, Russia-Ukraine war, number one. Number two is the China COVID. Okay, so China COVID control, they're not able to control, it's exploding there. And because of that, naturally, a lot of factories are shut or a lot of ports are shut, and which is creating a supply chain issue. So throughout 2020, supply chain issues were there. 21 supply chain issues were there. We were hoping that second half of 22, it will be gone. Now, because of the war and this COVID in China, it's expected that the supply chain problems will continue for longer time, right? So this is one uncertainty. Second uncertainty, or it is actually certain that the Fed, US Fed is rates. Okay. So next meeting, they're going to increase. They've already said that. And over next 1.5 years, by early 2023 or first half of 23, consistently, they're going to continue increasing till the rate which is 0 today or 0.25 for Fed rate or 0.5, that will become 2.5%. Okay. So when interest rates is being increased, your discount rate for equities starts going up also, right? And which gives a little bit of a downside to the market from the valuation perspective. But on the other side, the earnings growth is continuously going to happen, especially for Indian markets and US markets. The earnings growth is not, I mean, it will go through some fluctuation because of the supply chain and war issues. But overall, the trend for revenues and profits is on the higher side because Indian economy is doing very well and US economy is doing very well. Unemployment is at very, very low rates. People are not able to find employees in Indian markets as well. You have seen that in IT firms, people had to give salary hikes of 2 to 3 times. Three times. Can you imagine someone is getting 5 lakh rupees, he's being paid 15. Okay, in the next job, and he's getting 4 or 5 or 6 job offers. So that's the kind of situation today. Okay, and so anyway, coming back to your question, so even when we say lump sum, I will say divide it into 3 tranches. If you have 10 lakh rupees, 3 lakhs today, 4 lakhs next month, 3 lakhs again. Okay, and then SIP is evergreen. There is no doubt about it. SIP absolutely you should go and do. Okay, that is at any kind of market situation, even at bubble peak, when you start doing SIP and you are going to stick to it. As the market crashes, you make more and more profitable investments, and over 3 to 5 years, it builds a significant wealth, and it's much higher returns than market, right? Just because you did SIP. So SIP is extremely powerful. If you have small sums of money which you can deploy every month, we have already shown you the power, right? Remember the 15-15-15 rule. 15,000 rupees at 15% for 15 years, that builds a crore.
True. Yeah, so definitely everyone, at least to start some SIP investment, what I can say there. Right. So, adding to your point, because you were talking about the inflation and the interest rate might goes up, right? So, I was wondering about your another product on the dividend investment. There is a small case basket which is investing on the high dividend yield companies, right? So, what will happen for that investment if interest rate hikes? So, the companies which gives more dividend, say what happens when interest rate changes over there for the share price?
Yeah, so that's an excellent question. So you have 3 alternatives, right? you could go to bank FDs.
Yeah.
Okay, in bank FD, they have said 5% for 5 years, then you will get 5%. Whatever happens to interest rates, and your principal is fully protected.
Yeah.
Okay, there's no question about that. So that's the safest. But the returns you're getting there are very low, right? They are giving loan at 6.5% for home loans. How can they give you more than 5% in FD? Second is, some people go for those corporate FDs, etc. You remember that the return, first of all, there is a lock-in for a long period, and they might be higher risk. Okay, it's not like a bank. There is that a guarantee is there from government of minimum for 5 lakh rupees. There is a guarantee, right? The third one is you go for bond funds. Now there, if you go for long-term bond funds or mid-term bond funds, what will happen is as RBI increases interest rates, your bonds are going to lose capital, the face value. Okay, so you will face a principal loss, even if it's only the government of India bonds, AAA bonds. Even then you have this risk, interest rate risk, that's called. So you want to be on the side where inflation favors you, where increasing interest rates favor you. So if you go for super dividend, omni super dividend, naturally it's pure equity, so the principal will fluctuate. Okay, no doubt about it. But these companies, the revenues are continuously growing. From an inflation point of view, actually inflation is favorable, right? They will be able to increase the prices and pass on that, right? So as their revenues and profits increase, their dividend payouts is likely to increase. So not only that, right now you're getting 6, the chances are that 6 could go to 7% eventually.
Okay.
On your current value, you might be earning 7% in a few years' time. So that 6 will go to 7, 7 could go to 8 over a longer period of time. Your principal is also increasing.
Okay.
Right? As Mr. Market reprices, 6 months, 1 year later, it might be lower or higher. I can't say. But 3+ years from now, the revenues and earnings of those companies are higher. The book values of those companies are higher. The payouts and dividend and cash flows is higher. So naturally, Mr. Market is going to price it at a most likely at a higher price. So you get principal gain, you get payouts.
That's great. So we got some questions here. So Renish is asking, when a SIP is done monthly, will the unit price get average? And if it happens, the price will significantly go up if the stocks are upward moment. So he's asking basically about the SIP doing, and when the share price goes up, our average investment also goes up, right? So he's asking about that. So what will be happen for the return? He's asking maybe.
No, it's true. As you know, today, let's say the SIP is 20,000. And naturally, when the stocks start appreciating, the unit price will go up. And so you have to invest a little bit more. But Smallcase, interestingly, allows you to invest even once you have done a first investment. First investment has to be at the minimum ticket size. After that, it allows you to invest slightly less than that also on SIP basis. Okay. So it's not that you have to do, let's say the 20,000 goes to 23,000 in a few months, right? So it's not, ideally you should put 23,000, but sometimes even if you have only 20,000, it will accept it. And it will create a portfolio which it can create from the same stocks. So it is slightly mismatched to the ideal allocation, but it is not bad.
Maybe that's a concept of SIP as well, right? We might buy something higher and lower so that we get something average. So that's a basic concept. I think that's very clear there. And Agustin Paul is asking about the charges. So he's asking how to justify 2.5% of capital charges with direct mutual fund. So it's a comparison about the mutual fund charges where it might be below 0.5%, and here it is 2.5% in a small case. So maybe if you can bring up with the returns and the risk and all, that will be great. The comparison about the charges.
No, so first of all, I mean, hardly few mutual funds will be at 0.5%, maybe ETFs. Okay, but if you talk about mutual funds, they're typically at 2.5, some are at 2. So it's similar, and there are other expenses, right? So when they say 2% is the fees of mutual fund, that excludes the broking charges. Okay, broking charges are additional there. So that is also there. So it's similar in our opinion. And rather, I would benchmark our fees. You should compare with PMS and AIFs. Okay.
Sure.
In PMS, because this is a much more selective portfolio compared to mutual funds. Mutual funds would have 60 to 80 stocks. Okay. And usually they're all the weightage is on large caps, right? Because they have so much AUM, 20,000 crore AUM, 10,000 crore AUM, that they end up, even in a multi-cap or a flexi-cap, they end up with more allocation to large caps, slightly less to mid-caps, and then smaller to small caps, right? So this is the typical structure of a mutual fund. While a PMS, AIF like things, where you will have 2% or 2.5% plus performance fees of 20%. Okay. So we are providing a similar kind of things like a PMS like a strategy or a AIF like strategy on this platform at 2.5%. So, and especially for small ticket sizes, it works very well. Okay, better than the fixed fees.
So actually, I'll put it to another context that maybe the comparison is wrong when we compare with the mutual fund here, because mutual fund is something very kind of moderate or conservative mode of investment, whereas small case and PMS and alternative investment like hedge funds are kind of high risk and high reward game, right? So I will say one more thing: when you looking to the mutual fund return for the last 1 year, you might see the return is something similar to small case returns or something more than 20%, but it is not the game when you're going for a long run, right? So if you're looking to the 5 years or 7 years return of a mutual fund, same mutual fund what you're looking, you might see it is around 15% kind of return. So I would say maybe when you're going with a small case investment for long run, what the payment, what about the charges you pay, you might get something additional returns when comparing with mutual funds. If you want to compare with mutual fund, I would say you might get something better returns here, and it have more flexibility there. You can manage your position. When it comes to a mutual fund, you cannot argue with the fund manager whether to go for the investment or not. But here you can see the, I'm not saying that you need to change on your the portfolio and all, but anyway, you, even if you can see and manage your position a bit, I would say it is as a kind of more transparent and more flexibility over there. Maybe many of the fund managers in small case also charging 2.5, and Agustin mentioning that Windmill is charging very less, but Windmill is a kind of subsidiary of small case itself, so they have something free small case as well on the platform, right? And okay, Augustine also asking one more question over there. So what happens when, say it's a kind of normal question only, what happens when market going negative and say market giving a negative return? On top of that, we are getting a 2.5% charge. So any comment?
No, I mean, see, so when market is going down, it's not like, we have to, in fact, that's a better opportunity. That is when your fund manager has to deliver value. So value is not in seeing your NAV in positive. Value is that what changes we are doing when market is down. Okay. Are we able to find even better stocks? So let's say there is a stock in the portfolio with the expected return of 15%, right? We have put in. So we have done some estimation. And now in the market, we are able to find a stock because market is down, which is available at 25% expected return. If I add that to the portfolio, your expected return of the portfolio has gone up. And that's exactly, so when market is down, our hard work increases even more. Okay. So that time you're paying 2.5%. And let me tell you what is 2.5%. On 10,000 rupees, what is 2.5%? 2.5% is 250 rupees annually. You're paying 20 rupees per month to your fund manager sitting here to discover stocks for you. Okay. I mean 20 rupees. Just remember that. Okay. That's what you're paying per month for us to give you the best stocks in the market.
True. That's, see, actually, that's what I would say that before when someone want to invest into PMS, one of the main doubt was that there was some PMS charging fixed charges and all, kind of very, it was very unclear when someone coming to an PMS, and it is not accessible for a retail investor as well. So I would say Smallcase did a good job over there. Definitely. And Swapna Menon is asking, in small case, even we select SIP, should we deposit same amount monthly, or we can change depositing amount less or more than SIP amount? I would answer that question. I mean, you can change the small case amount. I mean, the SIP you can modify anytime if you need it, and it might not be the same amount because there will be some changes on the share price changes. The you can change your amount as well, right? So modification is possible, very much possible on small case platform, for sure. And so because I would ask another question there. I mean, when it comes to the SIP, I see many of the small case baskets over there, but none of them were none of them were offering something focused on the SIP side. So that's where I was very interested with your company as well, because you are offering something on the SIP side. As I mentioned earlier, we are most of our community members are traders here, so they might able to do some SIP rather than a lump sum investment. So how you can differentiate? I mean, comparing with other small case, what is the added advantage your SIP basket having, and how it will add value when we do SIP over there?
So first of all, you'll see the ticket sizes that our SIP baskets are 10,000, 15,000 and 20,000 approximate. So very much suitable that whatever little bit of profits you make and you want to now not, book your profits and keep it for long term. This is one way of doing it, that small ticket. And then second point I pointed out that it's like 20-21 rupees per month is the fees for 10,000 rupees investment. That's very, very little. So compared to a fixed price basket where, typically it's like 10 or 12,000 per year, you're just paying 250 rupees for a 10,000 basket. Okay. So there whatever is the basket size, the amount is fixed. So on small basket size, that amount becomes very heavy unless you're generating extraordinary return, right? So on a 40,000 rupee basket, typically I've seen people have something like 10,000 or 12,000 per year, which is 1,000 rupees per month. Right now, we are getting 20 rupees per month for a 10,000, or you can say like 100 rupees per month for 50,000, right? With 2.5%. So it's a very small amount, and that's the advantage, I think. The ticket size being low, and because we are doing a 2.5% rather than a fixed fee, it works very well for small ticket sizes. Very favorably for them.
Okay, great. And I hope the minimum investment amount will not rise spontaneously. It will be around below or around 20,000, I think, right? Maximum.
At each rebalance, we attempt to keep, around 20,000 for the Royals and Knights. Okay. Maybe it will go to 25,000, but we will not let it exceed that. And okay, ideally between 15 to 20. And for small Supertrons, small caps, we are trying to keep it below 10,000. We actually had put it at 6,000 or 7,000 earlier, but it appreciated and now it's at 10,000. So next rebalance, you will see it go slightly below 10,000.
Okay. So to clarify, their minimum investment is like a first entry ticket maybe, but everyone can do lesser amount of SIP, right? So can you specify the SIP amount for that 3 SIP baskets you have? Either for FlexiCap also you can add.
See, I cannot answer that. Let's say you have done 20,000 for the Knights. Okay. Yeah. What I cannot answer is how much small case allows, because small case has some kind of a complicated formula.
Algorithm they do have.
Yeah. On what amount they allow for, but it allows, I think, even 5,000 rupees you might be able to put it.
We can say it as to 5 to 10,000 maybe, right?
Absolutely.
Maximum 15,000.
Yes.
Okay, that's great. Okay, so Sharad is asking another question there. Do we have a less rebalance frequency? So it is about the rebalancing. So how often you do rebalancing on small case?
So we have a set quarterly rebalancing. Okay. For everything. More frequent is not there on a systematic basis, but sometimes, let's say market fall is there, or we find something very, very extraordinary to add to the basket or change the basket, right? Then we might go in between the quarter and do it.
Okay.
But that is if we find an opportunity. Otherwise, it has to be, for us, it's only quarters. Because see, we are fundamental investors. We are not doing technical trading, right? So for fundamentals, only when new fundamental information, the quarterly earnings and revenues are available, then we go and make the modifications.
Okay, that's great. And say another question there, it's a general question. So say someone coming to the market now, I mean, say as a fresher or someone. So how do you prefer their asset allocation at this point in time?
So if someone is a first timer, I would ask them to stick to the large caps, right?
Okay.
Ideally, so that they don't get in trouble. They are not, they're low risk today until they understand. So stick to the royals, and only when you have a longer term horizon. And super dividend is another way you can do. So you're at least getting the income regularly. And first time you start with 10,000 rupees or 20,000 rupees or 50,000 rupees in the super dividend. Of course, that will also fluctuate, but that's also a low volatility, as you can see, and it also gives you out the income. So that gives a little bit of comfort to the first timer. And once they get used to it over next 3 months, 6 months, 1 year, then they can go for the other baskets, higher risk one.
Okay. So apart from this, how much you might prefer on equity, debt, gold, like kind of asset allocation on that side?
Yeah, so we have a product called Omni Super Assets, which right now, fund folio is not selected, but that has 9 asset classes. Okay. It has long-term, it has a large cap, mid cap, small cap. It has long-term bonds, mid-term bonds, short-term bonds, gold, silver, infrastructure investment trusts. So it has all alternative asset classes, right? It is one product where everything is there. So that kind of, it even had global investments. So when rupee crashes, you would get benefit from that. When inflation happens, gold and silver give you the gains, right? Then we have technology. So when global markets are doing better, you get that. So it is designed for all kinds of situations. Maybe you can add it later. But yes, we think you should have a little bit of gold and all that, but in a systematic manner.
Okay. Right. So now I'm asking a minimum 10,000 for 1 year or 1 month. So maybe the entry minimum investment is she's asking about.
No, minimum investment is one time. So I can just do 10,000 right now and that's it. Okay. And you can do it forever. If you don't want to gain more, you can just put 10,000 and that will be fine. Okay. But you want to gain more, naturally you have to put more money. So the recommendation is to do 10,000 every month. Okay.
Okay, great. And there's another doubt there. So on your mid-cap fund, we see that currently if you're looking to the allocation, pure mid-cap, it is less than 30% currently. I think it is 28 or something on the fact sheet what we have, we can see over there. So do that really justify as a mid-cap fund, or, and I also see that the market, say the benchmark, it is mentioned as a multi-cap. So can you explain on that side?
Yeah. So I think there is some mismatch between how Smallcase is classifying. As I mentioned, the way we classify is we go by the AMFI list. So SEBI twice a year comes out, the AMFI comes out with that list of what is large cap, what is mid cap, what is small cap in January and then in June. Okay, after June. So every 6 months that list is there. We use that list, and the top 100 are called large caps by market cap, full market cap. Next 150 is mid cap, and everything else is small cap. So we use that list to do our selections. What can happen sometimes is that we have selected and then those stocks move to the large cap list, or those stocks go down and move to the small cap list, right? Because of price appreciation or depreciation. So sometimes that could be the explanation. Sometimes, maybe 1 or 2 stocks could be not from the mid cap, but I don't think there is some mismatch in classification.
Okay.
Yeah. And because the mismatch is there, the benchmark they have picked as multi-cap because it looks like that.
Okay.
Yeah. Yeah.
Okay, clear.
It's automatically picked up by their system.
Okay. So it's great. So I think we are already running late. So it's already 12:30 now. So we has to wind up here, seems to be. Right. So Vikas, thank you so much for your time. And Ashwini, yours as well. And thank you so much for all the participants. So whoever missed the session in between, they can look into the YouTube. We'll be uploading on the YouTube channel so that you can see it again if you require. So any further doubts, please revert to me, or you can write to OmniScience mail as well regarding the products. So hope it's very clear. So any last questions for anyone? I mean, please take some last question also. By Zakaria is asking some question. I think we will take last question from Zakaria and close it up. Zakaria, anything? Okay. One sec, we'll wait for that question as well, maybe.
Yeah, so while we are waiting, I would just like to re-emphasize the disclaimer. Yeah. Any numbers, if I have said that, this is the return, that is the return, definitely you can't go by past returns and project that in future. Okay, and we are not guaranteeing any returns or committing any returns. Yes, market is rewarding. We are trying to beat the markets through a very systematic process of scientific investing. So we hope to beat the market, but that is not a guarantee, right? Equity markets are risky.
On that side, say for a general note, can you say any kind of SIP, say expected return range for your small cap and flexi cap kind of thing? Any
Absolutely
range?
Not. Absolutely not. Okay. I will just say that you look at Nifty and Sensex, and just to remind you, Sensex has gone up. It started at 100 rupees. Okay, Sensex in April 1979. Today it is. What do you think? You think it's 58,000 or something? No. Actual Sensex is at around 75,000. This is including dividends. Okay. There is a Sensex total return index. So that is 750 times your wealth has grown over 42, 43 years. Okay, 750 times. Now, second point, Nifty itself, you think it started from 1,000 rupees in 94. Okay, today it is at 17,000 or whatever, 18,000. No, it is actually closer to 25,000. Okay, so 25 times in last 25 years or so, 25, 30 years. Okay, so it's very powerful. Equity markets, you don't need to worry about what is my expected return or anything. Just invest systematically. Rule of 15, 15, 15. 15,000 per month at 15% returns for 15 years, you will get to 1 crore. Always remember that.
Yeah, great. Okay. So the question is the follow-up question regarding the charges. I think I'll take it up for the comparison and conclude it over there. So I think you mentioned something on the mutual fund. It is 2.5% for the charges. So that's a confusion by the investor. So basically, when you coming to a mutual fund, it is, you can see something below direct fund charges. You can see something below 1%, or if you're going with an index fund or something, you can see less than say 0.2 or 0.5 as well. Okay, so that's true. Mutual fund have very less charges. So I think the question is asked by Augustine again. So charges is very less, but what I do prefer that Smallcase is not comparable with the, on the charging side. You don't compare mutual fund and Smallcase because mutual fund is something different on the, say what I can say, the investment methodology or the strategy, because it's kind of conservative and it is not coming with a rebalance, or very frequent research is not required on that side. But when it is coming to a PMS or hedge fund, there is a high resource needed for the research and all, so that they need to spend on that side. That's the reason when you're coming for a Smallcase or PMS, they are charging high. I can say they are not very greedy on that side, maybe because they have more expenses on the research side when it is comparing with the mutual fund, maybe. Okay, so the charges you just compare with the PMS rather than comparing with the mutual fund, I would say. Maybe as a personal note, what I do prefer when we going for an aggressive a Smallcase, we are expecting more return than a mutual fund, net return, I would say. Say after all the charges, maybe when mutual fund give around 12 to 15% CAGR, we are expecting little bit more than that. So if you required to get more returns by taking kind of aggressive investment, might be Smallcase will be a preference for you. But if you just needed maybe 12 to 15% kind of return with very conservative mode of investment, you can go with a mutual fund, I would say, with very less charge on the net side. Okay. That's from my note. It is not from the OmniScience team, so it's a personal. So I need to conclude it by 12:30. That's the reason I made it a rush. Okay, so I think that's it for today. So thank you, Vikas, and thank you, Ashwini. Thank you so much, and thank you everyone for joined in the session for today. Yeah.
Thank
So
you.
we will wind up this.
Pleasure.
Okay. Thank you so much. Bye.
Thank you. Thanks, Vivek.